So welcome back to our discussion on the financial statement analysis. Before T we saw that the accounting is a process of converting business decisions into financial statements, and the business decisions can be of financing decisions, investment decisions and operating decisions, and all these business decisions will involve financial items, and the financial items are incomes, expenses, assets, liabilities and equity. And all these financial items will appear in the financial statements called balance sheet, income statement and cash flow statement. And this process is governed by the generally accepted accounting principles, and which consists of accounting standards. And over the period of time we may see convergence of all the domestic gaps into the international financial reporting standards. And this process can be captured very nicely through the accounting framework called accounting equation. And the accounting equation says the sources are equal to assets, and our focus was on the sources. We had a question in our mind, what are the various sources a company can use or to finance its assets. And we have seen that the assets can be financed by either capital, which is the share money contributed by the shareholder, or the profit, which is money generated by the business, or the outsider's money, which is the money contributed by the outsider. And to understand that, we had a specific question that how is Infosys financing its assets. And we saw that Infosys is about 83% of the assets are financed by the retained profits as per the financial statements as on 31st March 2011. And this is called the equity financed company because a large percentage of the sources are in the form of equity. And equity can be computed as asset minus liability, or equity can be computed as capital plus reserves, and equity is called the residual value or the residual amount that the shareholders receive after meeting all the obligations, both statutory and contractual. And in this session we will take the discussion forward and understand what are the various sources and what is the effect of this debt and equity. So as I mentioned, in order to undertake the financial statement analysis, one need to have questions. If you don't have questions, you cannot start or make a beginning of the analysis. For example, we already started with a question: how is Infosys financing its assets? And that is called understanding the financing decision. So understanding financing decision means understanding the sources of funds. And the sources of funds are shown on the sources side of the balance sheet. So understanding the financing decision is understanding the sources side of the balance sheet. And we know that the sources side of the balance sheet will have the outsider's money and owner's money. So financing decision is reflected by combination of sources in the form of debt and equity. So the debt equity ratio reflects the financing decision. To make it very simple, if I say that high debt equity ratio company, that means it is using more debt. If it is low debt equity company, that means it is using equity to finance its assets. But a question can come to mind that what is the relevance of the debt equity ratio? Why is debt equity ratio relevant? The debt equity ratio is relevant because, as we will see today, it affects the profit after tax. Debt equity ratio is relevant because it affects the earning per share. Debt equity ratio is relevant because it affects the risk or affects the interest coverage ratio. The debt equity ratio is relevant because it affects the weighted average cost of capital. So whenever we want to answer this question, how is a company financing its assets? Don't stop there. After finding an answer to this question, you have to examine how the debt equity ratio is affecting PAT, EPS, interest coverage ratio, and the weighted average cost of capital. We'll take a small example to understand that effect, but there can be a question at while discussing this, which can be, you can keep that at the back of your mind, that is there anything called optimal debt equity ratio? We're not answering that question now. Our focus is to understand, is debt equity ratio relevant? But to answer that question, let us try to distinguish between the debt and equity. How different is debt and equity? So instead of saying individual items, let me pick up few specific distinctions between the debt and equity. Interest on debt is mandatory. Dividend is not mandatory. Debt is repayable. Equity is not. Equity holder gets the right to vote. Interest is a tax deductible expense, but dividend is an appropriation, so it is not a tax deductible expense. And the cost of debt is invariably lower than the cost of equity. So that further strengthens our understanding, or the need to understand, that the manager of a company should always keep a watch on the debt equity ratio, because it affects so many things like PAT, EPS, weighted average cost of capital, and interest coverage ratio. So let us take an example to understand the effect of DER. To make the matter simple, I've assumed that there is only a debt which has a rate of interest given as 10%, and the capital was face value is 5. So the total capital employed is 100,000, and we are keeping that 100,000 constant over these 4 or 5 cases, but we are changing the debt equity ratio. The composition of the sources of finance has been changed from 0.3 as a debt equity ratio to 4 as a debt equity ratio. You can see that the profit before interest and tax, which shows the profit generating ability, is not dependent on, is independent of the DER. In other words, the debt equity ratio will not affect the profit generating ability of the business. The amount of capital may affect, the amount of debt may affect, but not the composition of the debt and equity. So let us take the interest now. Interest 10% on the debt, interest 10% on debt. So therefore in all the 4 cases, the interest is charged against the PBIT. So PBT is affected by the debt equity ratio. And suppose, assuming that there is no difference between the tax profit and accounting profit, we charge the 30% tax on that, and so the tax in all the 4 situations will be different. So the PAT was 12,600 and is 8,400 with the change in the debt equity ratio. So PAT, which shows the profit generating ability, so PAT is dependent on the debt equity ratio. So the debt equity ratio affects the profit distributing ability, but has no effect on the profit generating ability. One of the other variations of the profit generating ability is reflected by earning per share. And earning per share is a PAT divided by the number of shares. So earning per share in the first case is 0.8, and earning per share with a change in the debt equity ratio is increasing from 0.08 0.8 to 2.1. So EPS also changes with the DER. High in this case, higher the DER, higher is the EPS. But with the change in the debt equity ratio and constant PBIT, increasing interest, the riskiness of the firm, which is reflected by interest coverage ratio and which is calculated by PBIT by interest, will reduce. In other words, the PBIT, the profit available to pay the interest, reduces with the increase in the debt equity ratio. So if you put them together and observe that interest, EPS and the DR are differently related. I'm sorry. The interest, interest, EPS and the interest coverage ratio, okay, so we can pull it down. The higher the debt equity ratio, the blue curve, higher is the EPS, which is the red curve, whereas the interest coverage ratio falls with the increase in the debt equity ratio. So it is necessary as an analyst not to see the debt equity ratio in isolation, but observe the effect of debt equity ratio on EPS and on interest coverage ratio. But a question should come to your mind whether the interest, whether higher the DER, higher the EPS is going to happen every time. In order to answer that question, let us take this. Let us change the numbers and make a small change in this. That hide. Okay, let me hide the comments. Hide. Now here, suppose I change the PBIT from 20% to 9%. So my PBIT will be constant, but it will be 0.09. So 9,000 all through. Now you can observe that the EPS is slowly reducing with the increase in the debt equity ratio. Unlike the previous case where the higher debt equity ratio was higher the EPS, but here higher the DER, lower is the EPS. So don't come to a conclusion that the high DER is good or bad. It is necessary to understand the effect of the DER on the other financial parameters, indicators, and then come to a conclusion. It's possible that some companies have a high appetite for risk. Some companies would like to maintain a moderate risk. Some companies do not want to take any risk at all. So to summarize, I'll say that the debt equity ratio, which is a reflection of the financing decision, is one of the important ratios in the toolbox of the financial analyst to understand or to answer an important question, that is, how is a company financing its asset. all other things remaining constant, the size of the business, the nature of the business, the scale of the business all may be same, but the financing structure, if it is different, then the profit generating ability may be same, but the profit available for the shareholder or the profit distributing ability will be different. So when you say that the company is making profit, I would suggest you to make it more specific, whether it is a profit distributing or profit generating, and then examine the effect of the financing decisions on these PAT and PBIT. So as we move along in the next and future sessions, we'll get into some more financial indicators and consolidate our understanding on financing decision and its effect on the investment and the profitability of the company. Thank you very much.